Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Jeffrey Tucker. He is the founder and president of the Brownstone Institute. He is a former editorial director of the American Institute for Economic Research and the author of The Market Loves You, Why You Should Love It Back. Welcome back, sir.
Hey, it's good to be here. Thank you. I always appreciate your interviews.
Yeah, it's a huge pleasure having you back on, Jeffrey. It's such a critical time, too. The massive talk lately is, can our friend Jerome Powell keep raising rates with all the chaos that's in the market, that's piled up into the system as well? And how could Powell continue to raise rates without breaking something? And how will this affect silver and gold?
Well, he's already broken everything. He's broken everything, but he had to.
Yeah.
I mean, there's no other choice you have. I mean, this is the problem. This is the problem with easy money policies that really began in 2000. And then that created, a big housing bubble. And then rather than just allowing the markets to settle down and restabilize and for industry to get it, to coordinate itself across the fullness of the yield curve, instead, we got out of 2008 with zero interest rates, which created, like, I don't know, why did anybody believe that was a good idea? It's just crazy. Yeah, it saved the banking system. But it was a big fraud because the Fed just created a bunch of phony money to recapitalize the banks with phony capital, and then paid them to keep their deposits in the Fed to keep inflation at bay, which is a great trick. But you can't run an industrialized economy of any sort of with any sort of reasonable production structure on zero interest rates. It's like it's denial of natural law. So
Right.
of course, but that still went on for 15 years. And Powell tried to unravel it in 2019, but then the whistle blew, for the great pandemic,
Hmm.
and next thing you know, he was back to not only zero interest rates, but outright open market purchases. Somewhere I had $7, 8, 9 trillion were created through that ridiculous caper. And by the time he caught on to the foolishness of that, the inflation had begun.
Yeah.
Because this time it wasn't stuffed in the Fed. This time it was dropped all over the whole population. So now you've got a problem. You've got a problem that you've got to unravel this crap. And so Powell's not just battling the last 3 years; he's battling the last 22 years. And it's a major problem. What makes me crazy about this, and I decided to drive myself nuts this morning
What?
by rereading the chapter on the trade cycle, inflation and deflation, from a book called Human Action that was written between 1934 and 1940 in Geneva by an economist named Ludwig von Mises. And he lays out the whole scenario of how this whole process of the trade cycle takes place. And I tell you what, I mean, it's like Nostradamus, right? I mean, his description of exactly the course of what we've been through here is so bang on. If you start with let's just say a sound money system is not subject to any kind of large distortionary effects, and then that's replaced with a central bank with fiat money, and then you get these endless rounds, right? So you get, oh, now we're going to have low interest rates to address some great political
Crazy.
priority, and everybody's cheering, oh, this is the greatest time ever, I can't believe how prosperous everybody is, and I'm rich, and it's just glorious. And but then eventually, and of course the distortions come along at that point, right? I mean, he
Right.
describes it as sort of false savings, an illusionary prosperity, tremendously distortive to the production structures. Everybody's flinging themselves into long-term projects where they're not really sustainable because the underlying savings are not present. And eventually, this new money and credit leaks out into the real economy and starts driving up prices, and that begins to panic the Fed, the central bankers, and they have to reverse the process, and then slower growth comes along, and they have to do this or else they're going to face up what he calls a crack up boom. So they have to
Wow.
reverse this at some point. So the bad news has to come at some point. The hangover is going to hit you. You can't just keep throwing down tequila shots. So then the deflation happens, but the deflation is also damaging to the status quo, which was itself unsustainable. So he marches through this story, and paragraph by paragraph, I'm reading this thinking, holy criminy, this is written in somewhere between 1934 and 1940. And he got it exactly right. I mean, I would encourage
Wow.
anybody to go read that book. I mean, it is so exactly what we've been through. So it's frustrating to me that people wake up every day and, what the heck is going on here?
Yeah,
I
that's
can't
right.
understand it. Why is GDP so, why are we growing so, what are we going into a recession? Why is this happening? Well, you know,
You just have to look at von Mises.
yeah, right?
What does he
Like,
say? What does he say is the outcome? Like now that we're in a certain stage and there's so
right.
much knowledge you can gain and take from von Mises. What
Yeah.
happens now? What's the future outcome that von
Well, so
Mises
that's
teaches?
exactly why I read him. I
Right.
mean, because I was asking that question, like, what happens when over the course of a season you have a 5% decrease in the money supply, which is what we're
Right.
seeing happen right now. Now, Mises's model here would not predict. So what he says is basically that the consequences of the deflation, if it's allowed to carry itself out
Mhm.
entirely, are proximate to the false growth of the previous period.
Right.
So whatever the growth was of the past that was inflationary finance and credit is going to be flipped in the other direction under deflation and causing, an equal amount of destruction that we saw, fake creation in the old days. So we're going through that. If you want to reduce the increment of time here to just these 3 years, which is a helpful heuristic, that may not be accurate, but it's a helpful heuristic, then we've got to go through a big recession. It's going to be a big recession.
Absolutely. And people keep on comparing. There's a huge talk online about now comparing to 2008. But like in your opinion, will it be
No way.
way worse than 2008?
There's no way it has anything to do with 2008.
Wow.
Because 2008, you remember, we were facing, sort of more or less reasonable interest rates going into that thing. So the Fed had a lot of
More
downward
room.
slack to push this ZERP policies.
Right.
That is not an option this time.
Right.
There's
Wow.
no chance of that. I mean, there's no way in this physical world the Fed can do anything like that. I mean, they do you understand that, like, as of today, we still are not in a positive territory with the federal funds rate. We're
Wow.
still slightly negative. I think I looked at it yesterday. We're at 0.3 in
Wow.
real terms on the federal funds rate. So there is no room at all to repeat 2008. So, what should have happened after 2008 is we should have let, all the institutions that were crowded up with these MBS products
Hmm.
just deal with their fate, right? That's what should have happened. But we had room within the interest rate structures for the Fed to come to its rescue. We can only really do that one time,
Wow.
because then after that you've got a problem, because there's nothing below zero. I mean,
Yeah,
that's
you
it.
can't go lower.
Yeah. So there's no way the Fed can do this. So right now you've got the Fed just you just terrified about what the future looks like. That's why they're rushing to raise and raise. So just so you understand here, the Fed is not only increasing rates to get inflation under control, they're increasing rates as high and as far as possible, even if it leads to massive breakage, so
Jeez.
that they can build in some room for them to move in a policy sense in the future. Like right now, they have no room. They're in a cage of their own creation.
They
So
have
they've
to
got to
keep
build
raising.
themselves out. Yeah, they have to keep raising them so they can at least get the possibility of discretionary monetary policy back. I mean, that was shut off by Powell, not by Powell, by Bernanke. He basically threw all their tools at this one stupid housing thing, and then they weren't left with anything, and they've been doing this for the last 15 years. I mean, Powell tried to
Wow.
reverse it a little bit in 2019, but he was
Right.
subverted by politics. So so they've got to get their discretionary power back, just to get back on and doing what they think of as being normal policy. But I don't think they're going to be able to ever do that sort of normal policy ever again. Anyway, I think Powell knows this.
Mm-hmm.
We're driving towards a big recession, depression. And the lag in the reporting here becomes important, right? So we just got reports for first quarter GDP, and everybody's like, wow, that really sucks. 1.1%, that's no good. Yeah, right. I mean, who didn't know this? You looked at new factory orders, you look at housing. I mean, we've seen this whole thing coming, for months now,
For
right?
sure.
So all this data is backwards looking. So by summer, it'll be unavoidable.
Absolutely.
We're going to be in negative territory. But even then, I promise you, people are going to go, well, it's not recession yet because you have to have two quarters, of falling GDP. So they're going to have to wait, to the fall. And then
Right.
finally, the summer numbers are going to come out and the fall numbers are going to come out. It's going to be winter. It's like, all right, we definitely have a major problem. And then all the political players are going to be promising great solutions and bailouts and all sorts of money, but it's going to be a big problem because the Fed cannot monetize this debt without reversing its current tight money policies. So
Wow.
at that point, it's just going to be pure improvisation. But a year from now, holy moly, what's going to happen a year from now? We're going to be solidly in complete cultural, social, economic meltdown.
Wow.
Where
That's huge to say.
Oh yeah, no, I mean, but you could. I mean, I'm not one for making predictions both quantitative and in terms of the calendar,
Right. Yeah.
but yeah, I'm at this point so convinced because it's like it really is like clockwork watching
Well,
out.
you've seen the bond market already break, and you've seen so many things. Like my only worry is what's next. Is it going to be massive unemployment as they keep raising rates, or will it be the housing market first, or what commercial what hits next?
Yeah.
What are you watching
So
for?
so there's a couple of things about the unemployment that's weird today.
Hmm.
Labor participation is very, very low. So I don't think the unemployment rates from the past that we used to, obsess about from the 1930s all the way up until 3 years ago pertain much anymore because labor participation rates are really, really low right now. So that's
Hmm.
in effect large amounts of labor shortages in particular sectors, and the most of the sectors affected are sort of left side yield curve sort of sectors, and we're looking at retail and hospitality
Mm-hmm.
and building and construction and these kinds of work with your hands sort of laborers. You can't get anybody to do anything. I was sort of having dinner with a friend of mine who runs a landscape company
Yeah.
in New England, and he's like, what the hell? I don't understand it. I'm paying people $25 an hour to pick up sticks, and I can't get any employees, right? So it's, it's like, what?
That's hilarious.
So this is traditional unemployment, like we used to measure it, is not going to really pertain this time, but we are going to see a huge downgrade in salary expectations at the high end of unemployment. So
Mm-hmm.
it's the Elisa Heinerscheids, of the world. She's the one who ran that Bud Light, and she was pulling down 450K or whatever a year. Those are the people who are going to be in a lot of trouble in the future. Hey, she shouldn't worry about it. She can pick up
That's
sticks
right.
for my friend for $25 an hour.
And I mean, looking at all the central banks and what they're doing, they're buying more gold now that they have in the past
Yeah.
55 years. And are they preparing for something big, possibly full-on de-dollarization?
Well, the problem, yeah, maybe, but the problem is nobody trusts anything, and gold is like, isn't it? It's so funny to me that after all these decades and decades, finally people are like, oh, what the hell can you trust anymore? I don't understand anything about Bitcoin. So, well, I know I can always depend on gold. I mean, that's why you're seeing all the excitement about gold these days,
Right.
because this is the way humanity is. People float around to this, float around to that. Oh, times have changed. We've got a new economy. And wow, let's Zuckerberg's metaverse is the great thing or whatever.
There's one more feature coming soon that's probably the most requested feature on our roadmap. Legs.
And then, and then that turns out not to be so great. And people are like, well, we
let's
can,
move
you
on.
can always get some good value from
Yeah.
gold.
Wow, that's hilarious. It's such a huge pleasure having you on. But before you go, my last question is, with all the uncertainty in the market, where are you finding safety right now for your money, Jeffrey?
Well, I don't want to speak about my own thing. I always think that. By the way, I do think that financials have a long way to go upwards before they're profoundly
Really?
affected. Yeah, the real economy is going to adjust long before the financial economy is going to adjust. It's just a pure guess on my part, but I'm guessing that we're good at least until the end of the year. But
Yeah.
and then we'll start seeing the big adjustments downwards. But if you look at the way housing trends are going, all the good deals in real estate right now are in red states.
Hmm.
That's the place to be. I'm not in the even slightly bullish on any aspect of sort of blue state, old world, New England, coastal properties right now. They seem
Right.
to they've got a long way to fall, but that's not true in places like the Carolinas and Florida and Georgia and Texas. So, but I think you'd be crazy not to have some serious investments in gold,
Absolutely.
and all the index funds related to commodities and gold and real estate right now. That seems to be the place to be if there is one. Now, I'll make a final comment about this question of the dollar internationally. I mean,
Hmm.
that is definitely going through a shift,
Yeah.
and we probably turned the corner. I mean, there's no reason to be confident that dollar is going to remain the international reserve currency in perpetuity.
Right.
I mean, it's
Right.
no longer a politically neutral currency, but still it's going to be dominant for a very long time. I do think that the cause of the central bank digital currency has been seriously set back,
Why is that?
partially because of the economic chaos and partially because of massive public resistance and distrust. So
Right.
these are all very interesting events that are unfolding.
Well, it's such a huge pleasure having you on, Jeffrey, and hopefully we can have you back on very soon as the market unfolds and as we go through this recession together, we can talk
Right.
about it.
Okay, good. Yeah, let's talk again. And
Yes, please.
I'm hoping you'll be able to say I was right.
Yeah, you will be.
Okay.
Awesome. Talk to you soon, Jeffrey.
All right. Bye bye.